Meet Gill. Gill is a trainee accountant working in a big firm and has been asked to prepare the quarterly VAT return. She knows exactly how to prepare a VAT return, but she's seen a purchase invoice for a piece of gym equipment that has been imported into the UK. And she's not sure exactly how to account for this on the VAT return. She understands that there's something called imports and exports, but she doesn't really know a great deal about it. So let's go over the fundamentals of imports and exports. Now, goods bought by a firm are known as imports, and goods sold are known as exports. Imports and exports are treated differently if they are within the EU or outside of the EU or European Union. So let's take a look at what happens when imports and exports are outside of the EU. When goods are imported into the UK from other countries outside of the EU, then VAT is usually due at the same rate as if it was sold within the UK. When goods are exported from the UK to countries outside of the EU, goods are normally zero rated, so long as documentary evidence of the export is obtained and retained by the supplier and all laws are obeyed. So what about when goods are within the EU? The European Union, or EU, is referred to as a single market, and it's a phrase to describe trading within the member states that make up the EU. So when you take a look at a VAT return, you'll see that goods relating to the EU are not referred to as imports and exports, but instead are referred to as acquisitions or dispatches. Here, VAT is no longer collected at the frontiers, but from the buyer. We need to consider two significant properties here. So if the buyer is VAT registered, i.e. if Gill's company are VAT registered, then the goods are zero rated on dispatch. The VAT is then collected in the buyer's country at the rate within that country, i.e. for Gill's company this might be at standard rate, which is 20%, and this will feature on Gill's VAT return as input tax. If Gill's company were not VAT registered, then the seller would add VAT onto the goods at the rate in his country, which in this case is France. But what if Gill was the seller? So what if Gill's company was selling to Edward's company in France? Now there are certain conditions that have to be met in order for the goods sold from Gill to be zero rated. So firstly, Edward's company must have a valid VAT registration number, which includes the 2-letter country prefix, and this must also be quoted on the VAT invoice. Secondly, the goods must be sent to a destination in another EU member state. So if they were sent to France, that's okay, because that's within the EU member states. Thirdly, the supplier must hold documentary evidence that the goods have been sent. So if all of the above conditions are met, then if Gill sells to Edward in France, she can apply a zero rate or VAT to her sales invoice. So if all of the above conditions are met, then if Gill's company sells to Edward's company in France, then she can apply a zero rate of VAT to her sales invoices. Now let's discuss tax points. Now tax points are not points you get for completing your VAT return. In fact, there's certain points in time in a calendar month that you need to be aware of when preparing a VAT return. So if Gill dispatches goods to another EU member state with her company, the tax point is the earlier of the 15th of the month following the month of supply. So if those goods were sold and sent in March, then by the 15th of April, that would be when the tax point is. So it's the earlier of the 15th of the month following the month of supply and the date on the invoice covering the goods. So if the date on the invoice covering the goods was before the 15th of April, then you'd take that date over the 15th of the month following the month of supply. Now, if Gill receives goods in the UK, then the tax point is the same as when goods are supplied to the EU. So you still need to be the earlier of the 15th of the month following the month of supply and the date on the invoice covering the goods. But also, the VAT payable is now the rate applicable in the UK. For example, if we were looking at adult clothes, then these are standard rated, so 20% would be applied. We also need to consider what we call free zones and warehousing. Now, free zones and warehousing are storage facilities for goods which are usually near a port or near an airport, and they can be used to store goods received from overseas. Now, no VAT is due on these goods until the goods are released from storage to the UK buyer. Now, remember that because the goods received are from the EU, they are not imports but acquisitions, and so they're not subject to the import requirements which are due on non-EU goods. It's It's important to know where the place of supply of goods and services is. This will be where the VAT will be charged and paid. Working out where the place of supply of goods is really straightforward, but the supply of services can be difficult, and we need to make sure that we understand the following. So if the supply is being made to a non-business customer, then the place of supply is where the supply belongs. But if the customer is a business customer, then the place of supply is where the customer belongs. So if Gill sells to another EU country, then she will not have to charge UK VAT, but may have to register an account for VAT in the country of supply. If the customer is not in the EU, then Gill does not have to charge EU VAT, but still needs to include the sale in box 6 on the VAT return. So let's have a look at a few examples. So when a VAT registered business supplies goods to another VAT registered buyer in another EU member state, it must either zero rate the goods, so input VAT can be collected from the buyer in the other EU member state, or should it charge VAT at a standard rate? The answer is that it must charge at a zero rate of VAT. Second question. Which of the following is the tax point for goods supplies to another business in the EU? Is it the earlier of the date of the invoice covering the goods or the 15th of the month of supply? Or is it the earlier of the date of the invoice covering the goods or the 15th of the month after supply? And the answer is the earlier of the 15th of the month following supply and the date of the invoice covering the goods. So how might this look on a VAT return? So if we have a look at box 4 first, box 4 is for all the VAT reclaimed in this period on purchase and other imports. This is VAT reclaimed in this period on purchase and other inputs, including acquisitions from the EC. So it includes tax on acquisition of goods from other EU member states and errors below the error correction threshold on the previous returns. It should also include VAT due on zero-rated services from other EU member states. And this will be the same amount that's included in box 1 for those zero-rated services. Box 9 is for the total of acquisition of goods and related services excluding VAT from EU member states. And then finally, box 7 is the total value of all other inputs excluding VAT, plus the total that's in box 9. So that covers all of the purchase side or import side. So on the output side, in box 2, we include the VAT due on acquisitions from other EU member states. Box 8 for outputs is the total of supplies of goods and related services excluding VAT to EU member states. So box 6 is the total of sales and other outputs excluding VAT. This includes exempt, standard and zero rated supplies and supplies to EU and non-EU states. So here you can see an example of a full VAT return. And you have box 1 for VAT due on sales and other outputs, box 2 for VAT due on EC acquisitions, a total box for box 1 and 2, then VAT reclaimed on purchases and other imports in box 4, the net VAT to be paid to HMRC. So if your total outputs are more than your inputs, then you owe HMRC. But if your inputs are larger than your outputs, then you are due a reclaim from HMRC. In box 6 you have the total value of sales excluding VAT, box 7 the total value of purchases excluding VAT, and then in box 8 and box 9 we have the total value of supplies to other EC states excluding VAT and the total value of acquisitions from other EC states excluding VAT. So now that Gill knows all about imports and exports, she's able to share this knowledge with her colleagues. So let's have a look at some further questions. Supplies bought by a business from a country outside of the EU are known as acquisitions, disposals, imports, or exports. If you said imports, then you are 100% correct. Moving on. Supplies sold by a business to a country outside of the EU are known as acquisitions, disposals, imports, or exports. And the answer here is exports. Next question. Supplies sold by a business to a country within the EU are known as acquisitions, dispatches, imports, or exports. And the answer is dispatches, so well done if you got that correct. And finally, supplies bought by a business from a country within the EU are known as acquisitions, disposals, imports, or exports. And the answer there is acquisitions. True or false? When dealing with a business within the EU, we don't need any other information to apply zero-rated VAT to an invoice when selling to that business as a VAT-registered business ourselves. And the answer is false. There are 3 criteria that must be met. So as always, I hope you found this video useful. Please consider subscribing and I shall see you on the next video.